Welcome, everybody. Thanks for joining me. I'm Rick Edelman. I'm really glad you're here on this special webinar, which is incredibly timely. We're talking about Ethereum today and why the merge is so important. The merge just happened this week, and everybody's talking about it. Everybody's curious about it. So I'm really glad that you're with us talking about this, joining us for this session. Very happy to welcome on to the webinar today, Matt Hougan. Matt is the Chief Investment Officer for Bitwise Asset Management. And Matt, you can bring up your screen and audio when you're ready to join us. Matt has been widely regarded as one of the leading experts in the field of crypto. Bitwise, of course, one of the oldest and largest of the companies in the crypto space. And if you've been paying any at all attention on CNBC lately, you can't have missed seeing Matt Hougan and Bitwise there with fabulous new commercials that are airing on CNBC and elsewhere. Matt, great to have you on the webinar with us today.
Thanks for having me, Rick. Excited to be here, incredibly timely, and glad you've been enjoying the CNBC ads.
The subject is incredibly diverse and very important. We're going to delve into it. You have the opportunity to ask your questions. A whole bunch of you already did. You sent questions in advance, so I'm going to pepper your questions through the dialogue that Matt and I are about to have, and we will take your questions live here on the webinar. So just go to the bottom of your screen or top of your screen, wherever you happen to have your toolbar, and go to the Q&A box and just click that, type in your question, and we'll tackle as many of those as we can during this event. Matt, we need to begin with the very, very basics. Everybody's been hearing about the merge, has been paying any attention at all to crypto, but still, I am pretty confident an awful lot of folks have no idea what the merge is. So let's start there. What's the merge?
Great place to start, Rick. Hey, everybody. The merge is a technological upgrade to the Ethereum blockchain. People forget about this, but every crypto asset, as the people on this webinar knows, has an asset and a blockchain. The blockchain is a piece of software, and like any piece of software, it can periodically be upgraded to do new things. This is a major upgrade, right? This is Windows going to a major new edition for the Ethereum blockchain. What's changed in the merge is the consensus mechanism. That's the core engine of any blockchain. It's the technique that's used to ensure that all the instantiations of the blockchain are in sync and only reflect accurate transactions. And what's happening in the merge is that we're transitioning from something called proof of stake, which is what Bitcoin and some of the original blockchains use, to proof of work, which is a more efficient, newer consensus mechanism.
Opposite, Matt.
Right. Oh, proof of work to proof of stake. My apologies.
So it's really important to identify this because in the beginning there was blockchain. In the beginning there was Bitcoin, and there was only one way that the blockchain worked. There was only one coin, and that was Bitcoin, and nobody really gave that a whole huge level of thought. Over time, people began to realize this proof of work mechanism that you refer to, this authentication protocol for verifying the data that goes onto the blockchain. This is an energy hog. Proof of work requires complex mathematical calculations, and it requires a lot of computing power. And people began to express concern about the energy consumption, right? Isn't that what kind of led to the notion of something new and different?
Yeah, I think that's a big piece of it, right? So I think of it as akin to automobiles. A lot of us drive gas-powered automobiles. We're converting to electric-powered automobiles. Part of it is that it improves the environmental efficiency, reduces the energy consumption, not by a little. It's cutting the energy consumption of the Ethereum blockchain by 99%, and that's a big advantage. But there's another important impact for investors, which is the way that blockchains subsidize this huge investment in energy or in the consensus mechanism is by issuing that asset to pay miners to maintain that network. And this is a more efficient way of running a blockchain. So the amount of new Ethereum that has to be produced to subsidize the security of the network is being cut by about 75%, right? The inflation rate of Ethereum is going from 4.5% to about 1% per year. So there are two impacts of this new level of efficiency. One is reducing the carbon consumption by 99%. The other is that the blockchain is simply more efficient. And so it has to produce less new Ethereum every year to keep it up and running. That makes Ethereum more scarce and, in my view, should be supported at prices over time.
So there are a couple of investment theses regarding the merge, which we're going to tackle in a moment. But I want to go back a little bit to the technology behind all of this, in the sense that Ethereum came out 7 years now that Ethereum has been around. It began initially on the same technology as Bitcoin, meaning proof of work, meaning a big energy hog. And Ethereum at some point recognized the value, the benefit in moving to this alternative methodology, proof of stake, which, among other benefits, as you noted, uses much less energy. One big question that people have raised, Matt, is whether this transition from proof of work to proof of stake, in essence, going from gas-powered cars to electric cars, if we can use that analogy, is that transition going to go smoothly? And what are the risks if it fails to go well?
Yeah, it turned out that it went smoothly, right? It happened, it occurred well. It took much longer than expected. People estimated that Ethereum would go through this transition, a year or 2 years ago. So like many technological developments, it took longer than expected, but it appears to have gone smoothly. There were all sorts of risks. There are risks that you know, and of course, risks that you don't know when you do a major upgrade like this. Some of the risks that we know, people were worried about, would this lead to too much centralization? Would it trigger regulatory oversights? The risks that we didn't know, this is the core internal mechanism for how a blockchain functions. This is akin to changing an airplane's engine in mid-flight. And the Ethereum blockchain secures $100 billion plus of value. So changing the core mechanism on which something that secures that much value functions was a very high stakes technological exercise, maybe one of the most high stakes technological upgrades we've ever seen. It's actually somewhat incredible that it worked as smoothly as it did, right? There was effectively no blocks skipped. There were no issues that have emerged since then. It's been almost flawless. A lot of people are really impressed that an open source decentralized software program can execute this level of technological upgrade. I think it says good things for the future. So I think there was meaningful risk going into the merge that something would go wrong. And so far, it appears that it's gone swimmingly.
And was the conversion from proof of work to proof of stake, meaning energy hog to energy efficient, was that the sole reason for Ethereum wanting to make this switch?
Well, I mean, there are multiple reasons for doing it. Again, it's important to emphasize it's just a more efficient mechanism. I don't know if it'd be helpful to explain how those two systems work. I'd be happy to do that as well, Rick.
I think that's probably a good idea, Matt. I think there are a lot of folks who have heard of these two, but are not necessarily terribly familiar with them. So let's do a little, for 5 minutes, a one-on-one session on the difference between what is proof of work and what is proof of stake, because this is as fundamental as it gets, and it's really kind of important. It's really the difference between an internal combustion engine and an electric vehicle. So let's talk about that. Start with proof of work.
All right, I'm gonna actually start with a bank, right? If you think about what a bank does, they process transactions and they secure your money. And you pay fees for that. You pay checking fees, you pay overdraft fees, et cetera. But they're processing transactions and securing your money, and you pay fees for that service. A blockchain functions sort of like a bank, sort of like a database. It has a core function, which is processing transactions and securing the database. But there's no centralized entity. Instead, there are hundreds of thousands of copies of the blockchain existing out in the world, and they all have to work together to maintain that database security. The way transactions are settled in the blockchain is that a group of individuals, let's call them miners, you could call them stakers, but a group of individuals out there gather together valid transactions and propose them for settlement to the network. Now, one interesting fact, or one interesting thing that was solved by the Bitcoin white paper, is you need to find a way to make it cost something to propose a series of transactions for settlement. Otherwise, people will always try to cheat. If it's free to propose something, you can constantly propose sending all the Bitcoin to you because there's no cost. It's like an email spam campaign, right? There's no cost to sending out an email. And so spammers send out a billion emails. If it didn't cost something to propose settling a transaction, people would constantly be trying to scam it. So the way the Bitcoin white paper solved this is they make all these miners compete in a race to solve a complex mathematical problem. And the first person who solves it gets to raise their hand and propose a series of transactions. Competing in that race is what burns that energy. You have to buy semiconductor equipment. You have to use huge amounts of energy. You have to solve these fantastically hard mathematical problems. And that's what made Bitcoin consume something like 2% of the world's energy, right? All of this racing, which was just a mechanism to create a cost to these miners to propose something. What proof of work says is, or proof of stake says, is all we're trying to do is ensure that the people who propose transactions are doing it in an honest way. Instead of making them do this work, let's make them post a bond. So what you do in a proof of stake system is you literally post for Ethereum, and you say, I'm going to settle transactions accurately and honestly. And if you find that I'm not doing that, you can slash my Ethereum. You can take it, you can burn it, you can get rid of it. So instead of running these computers to create an economic cost, you just put up your staked asset and say, I'll do it honestly, or else you can take it. The advantage of that is you don't have this huge energy consumption. Again, you reduce it literally by 99%. It's the greatest sort of ecological transformation of a major technology that's ever occurred. And the other piece is it's just so much more efficient. You can think of it very simply. One is a very active activity involving computers and power grids and burning energy and burning coal. And the other is very passive. It's just saying, you know, here's my money. I'm going to be honest. If you can prove I'm not honest, you can have the money. And as a result, it just takes less effort to maintain the same level of confidence that transactions are being processed honestly. That's the switch in a conception.
So in proof of work, if I buy Bitcoin, somebody else is doing that calculation activity, the Bitcoin miners, we call them. And those are two very different groups of people. You've got one group that are doing the mining, another group that are doing the owning, so to speak. And those two often never meet, although miners, of course, end up owning as well. But you know, most investors, the overwhelming majority of them, have nothing to do with mining, and they are totally separate and distinct. Whereas in staking, very routinely, the only way you can stake Ethereum is if you first own it.
That's right.
So the owners and the stakers are tied at the hip. The stakers are the owners. Whereas in Bitcoin, the owners are not the miners. And that's a very big difference, which means the owners who are staking are also getting staking rewards. They're getting compensated for doing their staking, which is providing yet another avenue of profit that Bitcoin owners don't get.
Yeah, this is absolutely true. And it's really significant, Rick. We estimate that stakers will be able to earn a 4 to 8% yield on a long-term investment in Ethereum. And that's really meaningful in an era of 8% CPI prints. And when you compare it to other assets where you don't earn that yield, you still get the asymmetric potential returns of investing in the Ethereum blockchain, right? You still get Ethereum's price appreciation. But while waiting for that, you're earning a yield that is at this point keeping pace with broad inflation in the market. We think that this unique combination of three benefits, right? A vastly improved environmental outlook, the ability to earn a yield, and a lower inflation rate for Ethereum is going to make Ethereum the primary asset that institutional investors are looking at over the course of the next year. I think it's really made institutional investors think about Ethereum differently than Bitcoin, realize that they probably can't just own Bitcoin, they need to own both. And I do think that yield is particularly attractive in this kind of environment.
Which would argue that if you're going to get as much as an 8% yield and you're going to hold this thing for 10 or 15 years, you'll double your money from the yield independent of the price movement of Ethereum itself.
Yeah, I think it's a very exciting opportunity, and you deserve to, because you're putting your asset to work, right? It really flips the relationship on its head. I loved what you said about aligning stakers with investors. It really becomes the same thing. And I think it's transformational to the asset.
So talk about the risks of staking or the obligations associated with staking.
Yeah, the risk of staking is if you do it wrong, you can lose your asset. So I framed it as if you are intentionally dishonest, you can lose your asset. That's something we could control. But it's also the case that if you just don't do a good job, if you miss blocks, if it's your moment to do a block and you miss it, you can lose your asset as well. So there's some operational risks. As a result, I suspect most people will stake through a service. They won't do it independently. You can do it independently. If you have 32 ETH and you're a computer science nerd, you can set it up. Most people are going to stake through a service like Coinbase or through a fund company for the institutional custodian. And the other risk is you're locking up your asset. So there's a liquidity risk that you take on, right? You can't stake and then immediately go and sell your Ethereum because you're making that long-term bonded commitment.
So I want to talk about both of those in a little more detail. First, dealing with a staking service. That's kind of similar to buying stocks through a stock mutual fund or a stock ETF, as opposed to buying individual stocks on your own. Just delegate the task to somebody else. You're hiring a fund manager, fund company, let them do the work. And it's the same thing in staking. Just join what's called a staking pool, which is managed by somebody who's an expert at this, who will do it on your behalf. They'll charge you some fees for the privilege. You'll lose a portion of the profits, but you benefit from not having to do it yourself. And all the major exchanges, such as Coinbase, are providing this service for their folks. So it doesn't eliminate the risk of doing staking wrong, but at least you get the benefit that they're less likely to do it wrong than you, I would think, in that regard. What kind of, if you do go through a staking service, Matt, what kind of fees can you expect to pay them for the services they're providing?
I suspect those fees will come down, but you can see them take 20, 30% of the staking yield that's available, and they're taking on some risk and some operational challenges, but I suspect they'll settle somewhere around there. Rick, I make a lot of analogies to the securities lending process inside funds. That's behind the doors, but if you own a ETF or a mutual fund, there's a high chance that they're lending out the securities on your behalf and earning a yield on that, most of which they give to you, some of which they arrogate to themselves for that service. And that's the exact same thing that we're seeing here on the stage.
Exactly right. Now let's talk about the liquidity risk. If you are going to provide your coins to the staking service, you said you can't just turn around in a day to take your money back. Talk a little bit more about
Yeah, right now, it's actually locked up for somewhat of an indefinite time until something called the Shanghai upgrade, which will allow for people to withdraw it. Most people estimate that'll be 6 to 12 months down the road. In the future, those locked up times will shrink. You'll also see, and we've already seen, staking services provide a window to liquidity by giving you sort of a mirrored asset that you can trade on a liquid basis while locking up the staked ETH. Somewhat in the way that a commodity warehouse receipt works, right? You can trade around the commodity warehouse receipt without the commodity itself moving. You're seeing sort of staked ETH receipts being traded without the ETH itself moving. But of course, there are costs and risks to those as well. The important thing to remember as an investor is there is no free lunch in anything. The cost of this lunch of staking provides this yield, but there are two costs. There's operational risk and there's liquidity risk. You can't remove those entirely. If you ever see a service that guarantees you a risk-free staking reward with no liquidity risks, you should know that it's not true, right? You're taking on operational risks and liquidity risks. You're being compensated with a higher than market yield that ranges in the 4 to 8% range. That seems like a great deal to me, but those are legitimate costs and they should be understood.
So you need to balance these two issues. On the one hand, are you motivated to stake by virtue of the fact that over a 10 or 15-year period, you could double your return? Or do you want to be reticent, saying, I either don't understand or don't like these risks, lack of liquidity, the risk that somebody may do something wrong, losing my entire investment? You're going to have to make that decision for yourself, but make sure you're doing so consciously and deliberately. Let's shift, Matt, to the investment thesis now of Ethereum. Bitcoin, the oldest, the original, still the largest by market cap. It's a little under 50% of the entire crypto marketplace. Ethereum, number two, currently what, 20, 25% market cap roughly?
Yep.
And many people are anticipating that as a result of this transition, the investment thesis increases, it rises for Ethereum because it's going to spur greater institutional engagement, that institutional investors, pension funds, endowments, sovereign funds, and others are now going to have a new level of interest in Ethereum than ever before. Talk about why people are saying that and whether or not you agree.
Well, I certainly agree. From a big picture perspective, it's of course important to remember that the Bitcoin blockchain and the Ethereum blockchain do different things, right? Bitcoin is a monetary asset and a version of digital gold, and that appeals to certain people. Ethereum is a more functional, Turing-complete blockchain. It's the blockchain on which people are building DeFi, on which they're building NFTs, on which they're building stable coins. So even before you get to the merge, we were hearing more investors interested in Ethereum as a quote unquote useful crypto asset or useful blockchain, alongside Bitcoin playing its role as digital gold. So you have that going on. Once you get through the merge, there are just these sort of unavoidable facts of what it does to the asset that make it more appealing to institutions. So one, by removing that environmental overhang for the biggest institutions in the world, that was a stumbling block on their route to investing in crypto assets. They would think crypto assets were interesting, run into this environmental stumbling block, and that would lead to more discussions. So you've now removed that. So that eases the way. But by far the bigger impact are the other two aspects. The yield, which as mentioned, very attractive. And then this change in supply, which is really meaningful and I think poorly understood on the market. I can give you actual data on this, Rick. I'm looking at it live right now. Since the merge happened a day ago, there have been 398 ETH issued on the blockchain. And if we were still in a proof of work world, there would have been 18,000 new ETH issued on the blockchain. And that means just in a day, the supply of ETH that exists out there is down by 18,000 ETH. When you move this out over 3 months, 6 months, a year, etc., the change in sort of the existing supply is massive. Many people think Ethereum will actually be deflationary. In other words, the existing supply will shrink over time after the merge.
So
and this
largely
is
because of staking violations?
No, it's largely because of transaction fees. Remember, when you use the Ethereum blockchain to mint NFTs, to conduct DeFi transactions, you pay a fee in Ethereum, which is burned.
Right.
And if that burn is now measured against a much slower inflation rate, sometimes, and in fact, I think most times, it will lead to deflationary. So it's a commodity with deflationary supply and rising utility. That's a pretty good recipe for an asset. So I think that change in inflation rate is meaningful. People say it's like 3 Bitcoin halvings occurring at once. To contextualize the size of this.
Now, I think it's worth elaborating on the notion you raised about Ethereum being more, as you called it, useful, and why that is so. It is because Ethereum is considered a smart contract or programmable money. Explain why it's more useful, how it has benefits in the world of commerce that Bitcoin does not.
Yeah, I mean, as a piece of software, the Bitcoin blockchain is actually a limited programming software, programmable software. You can literally only program Bitcoin to do a few things like send Bitcoin, receive Bitcoin, store Bitcoin, do some very simple if-then transactions. It's amazing. It can store wealth in a digital format. It can move $1 billion anywhere in the world in 10 minutes. It's a fantastic breakthrough with large markets that it can address. But it
And
can
that
also
simplicity, Matt, is one of its benefits, meaning when the code is so simple, it's far less likely to be hackable. And that's why the Bitcoin network has never been hacked in its history.
That's exactly right. And if you think about what it's trying to do to be digital gold, you want that software to be as secure as possible. So it's perfectly designed to do what it does, which is to be the pet rock of crypto, to be digital gold. Ethereum is Turing complete, which means you could program it to act like the New York Stock Exchange. You could program it to act like a lending agent at your bank. You could program it to record who owns what NFT. The reason it's more useful is because it offers that programmability. People are building all these applications on top of it. And we can talk about why. I think those applications are going to fundamentally disrupt the core of the financial services market over the next 10 years in the same way Amazon disrupted the retail market. It allows you to do things with incredible efficiency.
And I think it goes far beyond the financial services industry. It's going to disrupt most industries. We're seeing it in the song rights category in the music industry. We're seeing it in real estate. Hotels are now beginning to sell hotel rooms as NFTs, as non-fungible tokens, which are issued via Ethereum. And this way you can buy a hotel room or reserve one, but if you end up having to cancel, you own the hotel night and you can resell it to somebody else. If you want to speculate on where the Olympics are going to be held in 2028, you could right now buy the hotel rooms in all those cities and resell those nights later when the Olympics gets closer. I mean, you can speculate in a wild number of ways. You can use this technology in the astonishing ways to solve business problems, such as counterfeiting. Salmon fishermen in Norway are doing this. Breitling is doing this. Parmigiano Reggiano, the big cheesemaker in Europe, is doing this to thwart counterfeiters because they can use the Ethereum and its derivatives of NFTs to track the product as it goes through the supply chain. You can't do that with Bitcoin. And because of that, you're going to have companies engaging in ways that they have not engaged in Bitcoin. And now with the elimination of the energy hog, companies are no longer suffering under the ESG criticism, and they'll be more likely to participate. At least that's the investment thesis. Do you agree with all I've just said?
Yeah, I absolutely agree with all that. I think it's going after an absolutely massive market. It's the fundamental core of the internet of value, and you're seeing an explosion of applications on top of it. And I think that does make it easier for certain institutional investors to understand. It's also easier to value Ethereum. It's very hard to value Bitcoin because it doesn't have cash flows. It works like gold. It's driven solely by supply and demand, whereas Ethereum, because it's being burned every time someone uses the service, is much more akin to sort of traditional stock valuation metrics. And it's much easier for institutions to get their head around how value accrues to the Ethereum token.
And so now there's a new phrase being bandied about called the flipping or the flippening. Bitcoin is the largest, as we mentioned, by market cap, Ethereum number 2, but there is suggestion that Bitcoin is going to fall into second place, that Ethereum will become the biggest. Hence the flipping of their ranking 1, 2, 2, 1. Do you think that's going to occur? Does it even matter?
I don't think it matters. I think it could occur, Rick, but I think both are going after massive markets. If you just think about Bitcoin, I think it's going after the digital gold market, the offshore wealth market, a small chunk of the monetary supply market. That's a market that's measured in the $10 to $20 trillion range. If it's modestly successful in penetrating that market, the price of Bitcoin could be significantly higher than it is today, right? It's less than $1 trillion as a standalone asset. It's going after a $10 to $20 trillion market. You can do the math of how much that would impact. So Bitcoin, despite not having the utility of Ethereum, has a long road to go to be substantially larger. Ethereum is just going after a different journey. It's an equally large, possibly larger market. It faces more competition and more risk. I certainly think it could flip in Bitcoin, but more likely, I think they're just going to go on independent paths, going after very large markets. It's like saying, will Salesforce flip in Microsoft? I don't know. They're both software companies, but they're going after entirely different journeys, right? They're using software in different ways. Bitcoin and Ethereum are using software in different ways. I think from an investor's perspective, you have to decide which way resonates with you, or maybe you just want to own both and participate in the whole journey, which is what we hear from most people.
In other words, we've got Coke and Pepsi, and if it becomes Pepsi and Coke, so what?
That's right. Yes. Yeah.
We've got a whole bunch of questions from folks, so I'm going to try to tackle these with you, Matt. We know that the primary way that Bitcoin could get hacked, there's really only one dominant way that people refer to, and that's what's called a 51% attack. Meaning, with all these hundreds of thousands, millions of computers scattered all around the world, for somebody to gain control of the Bitcoin network, they'd have to control the majority of those computers, meaning 51%, and they'd have to do it simultaneously. That is a pretty tall order, and this ridiculous hurdle to achieve is one of the big reasons that Bitcoin is considered, for practical purposes, unhackable, and why it has never been hacked. Is the movement of Ethereum from that protocol to the proof of stake, does that increase the chances of a 51% attack to Ethereum? In other words, does it make it more vulnerable than it was?
Yeah, that's a really interesting question. There are two sides to answer that, Rick. On the one side, the answer would be yes, because one of the challenges of mounting a 51% attack against a traditional blockchain is you have to install so much hardware, you have to arrange so many power contracts. It's a massive logistical nightmare that makes it virtually impossible in the Bitcoin network. And that wouldn't be true in a perfect proof of stake ecosystem, because it's literally just about money, right? And money moves quickly. You could amass a large stake. The flip side is that the cost of getting caught doing a 51% attack in a staking environment is significantly higher, right? If you attempt a 51% hack in a proof of work environment and you fail, you still have Bitcoin mining equipment. You can turn that on in a traditional fashion, and you've lost the cost of energy for a few hours attempting this crazy idea. If you attempt an attack in a proof of stake network and you fail, you lose your entire stake. The consequences are severe. It goes away forever. So it's made it easier, but raised the costs. On balance, because proof of work has worked so well for so long, I have a higher degree of confidence that it's resistant to that risk, right? And that's what you want from Bitcoin. But I think there's a game theoretic argument that actually the consequences of trying to hack a proof of stake system are so much higher that it will deter people making any sort of attempt, because you lose your entire stake, right? It's a severe consequence, not just a marginal consequence.
And the amount you have to stake is so much money that why do you need to capture more money by going after Ethereum illicitly?
I think that's right. The other thing I remind people is there's a game theoretic reason why we haven't seen 51% attacks on major chains, which is if you succeeded in a wild world where you succeeded, you would damage the credibility of that chain, destroy the value of the asset that you're stealing. So in the act of stealing it, you're rendering it worthless, which is, it's like if you stole a painting and in the act of stealing it, it was splattered with black paint and destroyed forever. Why did you go about doing that? So there is this economic game theoretic benefit that I think adds an additional layer beyond the logistical and economic consequences of trying to 51.
I'm reminded of that infamous quote from an unnamed general in Vietnam who said, in order to save the village, we had to destroy it.
Yes, exactly. And I think that's why you'll never see a major attack on a major blockchain.
Simon has asked a really fundamental question, and it's a really brilliant one, Matt. Who oversaw and managed the merge? Was it a company, an individual? Who did this?
This is what's so incredible. This is a decentralized open source system. So in a sense, it was managed by a community. Now, like any decentralized system, there emerge sort of core developers and key leaders who push forward what the proposals will be, the roadmap will be, and the community agrees on it, and then it's accepted by others. But this is unlike a software upgrade at Microsoft, where there's a product manager who oversees it and makes sure all the trains run on time. This was overseen in essence by a community through some proxy key developers, but embraced by the community as a whole. That's one of the reasons it's so important. There was a thought that you couldn't do this level of change in an open source decentralized software program. The fact that we've done that is really meaningful for where blockchain goes over the next 10 years.
It's impossible to have a conversation about crypto, especially with you, without mentioning Gary Gensler. So the SEC chair has been, we could choose any one of a number of words here, disappointing, annoying, a nemesis, an obstacle. We could choose any one of a number of terms, but the bottom line is that Gary Gensler, as chair of SEC, has been thwarting efforts, blocking efforts to approve a Bitcoin ETF. And he has been very vocal over the past month in particular about regulation and which regulatory authority is going to have control over the crypto marketplace. There is a big effort, a lot of lobbying in Washington, D.C. Will it be the SEC or will it be the CFTC? Or might it even be a brand new agency yet to be created by Congress? Gensler is lobbying very hard to be the regulator of record for this asset class. And he has laid down the gauntlet repeatedly, particularly in the past month with several speeches, saying that he believes that the overwhelming majority of digital assets are securities and should be registered with the SEC. And we are anticipating a significant amount of enforcement. You said this earlier this week when we were on stage together at the Future Proof Festival in California, that you're expecting more regulatory actions before the end of the fiscal year in the federal government. That aside, there has been a widespread acknowledgement, part of it coming from the SEC itself, that although they view the vast majority of coins and tokens being securities that are unregistered, Bitcoin and Ethereum are pretty well acknowledged as not being securities. They don't pass the Howey test, that they are commodities, and Gensler has said within the last month that they do belong under the auspices of the CFTC. But now we have a story in the Wall Street Journal this week regarding the Ethereum merge, saying that because of the merge, Gensler has made the statement that due to the fact that you are now enjoying staking revenue, that it comes closer to passing the Howey test, meaning, he's arguing, Ethereum perhaps should in fact be considered a security. Talk about your reaction to all that.
It's been amazing to watch, Rick. I didn't know that there was such a thing as regulatory ambition. But over the past few years, we've seen the SEC certainly, and even to some degree, the CFTC, exerting regulatory ambition to bring crypto within their bailiwick, right? They recognize that crypto is going to be much bigger in the future than it is today. They recognize that crypto is sort of the most interesting, exciting, and innovative corner of the financial services market, and they want it to be within their remit. I agree with Gary at one level, which is that when I look at the 18,000 crypto assets that exist, many of them do exhibit characteristics that look like securities. These are by and large the smallest assets, which tend to be almost exclusively owned by their founders and developers who control the governance of them, who conduct where they're going. And those do meet many of the criteria for being securities. What was interesting about his most recent speech is he said what you hinted at, which is even though the vast majority by number may look like securities, by market cap that may not be true. As crypto assets grow, they become more decentralized. I view his comments on staking as part of that regulatory ambition, where they're trying to stake out the biggest ground possible. I think there are two possible outcomes here. One outcome is we get new legislation that clarifies where they go. And that would be a great outcome, particularly if they ended up in the CFTC, but even if they ended up in the SEC, because it would remove all regulatory lack of clarity. The other one was hinted at Gensler's speech, which is maybe these exist between both agencies, and some are regulated here and some are regulated there. I think even if we got to that outcome, that would be okay, because the largest assets are by and large going to end up more in the CFTC's remit. I suspect we'll be debating this for another few years, though, Rick.
And I think that the answer, as you pointed out, regardless of what the answer is, will be welcome in the sense it'll provide clarity. There are too many people who would otherwise be engaging who are not engaging because they don't like regulatory uncertainty. And if I don't know the speed limit, I'm worried I'll get pulled over for breaking the law without knowing it. Yeah. So we need the clarity. We could argue what we would prefer to see in that clarity, but any answer is better than the present lack of answer. So I think that's very true. Do you think it's going to take another few years, though, before we're going to get there?
I wouldn't be surprised if we saw regulatory action against major crypto trading venues like Coinbase. I think Gensler has been very clear that because some of the assets they trade are securities, they should be registered. And I bet that that is true. So I suspect that corner of the market will move forward, but I don't suspect we'll get clarity on exactly which assets are or are not securities. That's such a challenging question. It's such a facts and circumstances question that I suspect that may take legislative effort, and legislatures move on a year or 2 year or 3 years.
Let's talk about how significant that impact may be. BlockFi was fined $100 million by the SEC earlier this year, or maybe it was late last year, and ultimately almost put them out of business. They ended up being sold to FTX for a fraction of 99% less than their prior market value, which had been valued in the billions. Yeah. If Coinbase is going to have similar regulatory action, being accused of selling unregistered securities, is this an existential threat on Coinbase and the other exchanges?
I don't expect so. Coinbase is a massive institution with 100 million users, and they're conducting a very legitimate business, and they're of a scale that they can handle greater regulatory oversight. And I suspect that's how they get to the next level of success. Will it be painful if that happens? Of course it would be painful. But on the other side of that is a more mainstream crypto ecosystem, and one where they have access to new opportunities. I suspect we'll first start to see them try to break apart different aspects of their business into different legal structures. And quite honestly, that would probably be better for investors from an investor protection perspective. Again, I've said this before, at this point, I think regulatory clarity is more important than regulatory quality. Of course, they need to be reasonable, but I think we're working towards a reasonable outcome. I'm very encouraged what we see from a legislative and White House perspective toward the crypto market. I'm encouraged what we see from the CFTC's perspective. And I think we just have to work through these issues with the SEC. But we're going to get to a place where crypto exists within the regulatory framework, exists within norms, and that's going to be the place that crypto goes mainstream. And I think we're getting there pretty quickly.
I share your views that we are seeing helpful responsiveness and levels of interest and engagement from the White House, from Congress, and from the agencies. But we're ignoring the 50 states. And we have seen them sometimes decide to get active. New York decided not to allow any more Bitcoin miners. California is about to launch legislation that has passed the legislature, and if Newsom doesn't veto it, it takes effect in only a couple of weeks, that everybody's going to have to be registered in order to do business in California, which would have, of course, a domino effect on a national scale. So to what degree might the states throw wrenches into all of this, where we're dealing not with just one regulator, but 51 regulators?
Yeah. Lots of wrenches, Rick. Lots of wrenches is the answer. And I do think if we were 4 years ago in crypto, this would have been an existential level risk. It could have really set back the industry. The difference from 4 years ago to today is we have an extensive crypto lobbying effort that can help normalize those proposals before they go into the market, that can help better inform those proposals. That's a sea change. And also the industry is larger and can handle larger levels of regulatory oversight. If you think the sort of legal and regulatory apparatus it would take Coinbase to comply with 50 different state level regulations, could they have managed that 4 years ago? Absolutely not. They didn't have the infrastructure. Now that they have thousands of employees, can they manage that? Absolutely, yes. Will it crimp profitability? Will it slow them down a little bit? Yes. But will it also sort of strengthen their position and unlock new markets? Yes. So I think we're at the scale where we can handle those issues. Am I happy about them? Of course not. Am I worried about silly regulations? Of course. But the crypto industry has matured to the point where it can handle that kind of headwind.
Let's talk. We have several questions on a given theme. I want to tackle these because this is a pretty significant item, and that has to do with the concentration of coin. It is argued that the founders of Ethereum and a few others own a very large percentage of Ethereum. Is that true, and is that a risk?
I think that's generally overstated. It's certainly true that the founders of Ethereum own a significant portion. But it's when you see things like Ethereum whales own 70% of the market, that's just fundamentally untrue. Usually the confusion people are making there is they're taking individual wallets from something like Coinbase that represents the ownership of hundreds of millions of people and consolidating them as a single owner. It would be akin to saying that all stocks are owned by Charles Schwab and TD Ameritrade and Fidelity. Of course, Fidelity may have one or two or three accounts and look like they own a huge portion, but underneath that is 50 million Americans. Those sorts of errors are what lead to these terrible news stories. It's relatively dispersed. It's getting more dispersed over the time. I don't consider this a major risk.
Related to that are the liquidity derivative, the liquid staking derivatives. Talk about those, what they are, because some of them are huge. I mean, some of these are 5 or 10 billion in size.
Yeah, this is a little bit what I hinted at earlier. The largest of which is an entity called Lido. What you do is you take your ETH and you post it there, and they stake it and earn a yield, which they pay back to you. And in exchange, they often give you a token that you can sell, which is staked ETH. STEETH, ST for staked, and ETH is the most common version of that token. What you would expect that token to do is to trade likely at a slight discount to actual ETH to reflect the fact that there's illiquidity underneath it if you wanted to redeem it. But it's a way of staking your ETH with a service and still retaining liquidity. Again, I bring up that potential discount to remind people that there's no free lunch. People were confused at first when these staked ETH versions traded at discounts, but those discounts were reflecting the fact the underlying is illiquid and liquidity is a cost. And so they should trade at a slight discount. But it's still an interesting service, right? Behind the scenes, they're staking for you, they're earning a yield. You retain the ability to have access to liquidity if you need it, albeit as a cost. I consider it sort of capitalism at its finest.
Exactly. This just shows the benefit of cottage industries, that there's always a need in the market. Someone figures out how to meet that need and they create market share. So no issue at all. Steve has asked, I think, as fundamental a question as it gets: if you stake through a third party, such as Coinbase, what if they make a mistake that causes you to lose your coin? Is there any type of insurance available that they provide or that you can obtain on your own to protect you against that risk?
Oh, that's a great question. The first thing I would say is I don't know the specifics of every staking provider, and I encourage you to look under the surface to find out. I suspect that they have different relationships. My only guidance to people beyond doing your research is you want to go, particularly at this stage, with the most established institutional providers that have the most on the line. Because one of the things that's protecting you is they don't want to harm their reputation in the market if they're a large entity like Coinbase. So particularly when we're at the earliest stage of staking and staking as a service, I think you should go with the best heart surgeon and not the cheapest heart surgeon, the most established heart surgeon and not the newest heart surgeon, and dig underneath the surface to see what response you have. But chances are you're probably exposed to some risk.
So Ethereum's move to proof of stake is, I would say, a pretty strong confirmation that proof of stake is a very valid protocol. You could argue it's better than proof of work because they were proof of work and they've gone to all this trouble to go to proof of stake. So clearly they at least feel proof of stake is superior. But they're not the first to do this. They didn't invent proof of stake. Others did. And you could argue that Ethereum is in catch-up mode. There are other tokens that are using proof of stake already. So does this legitimize those? And does it really argue that you should be paying more attention to some of those other coins that are on the proof of stake protocol already?
Yes, it legitimizes those. And it shows you that this is an innovative industry, right? The electronic Ford Mustang is the car of the year. And it wasn't the first electronic car. That was, Tesla and others that innovated first. I think what this shows you is the right mental model for thinking about crypto assets and blockchains is thinking about software companies. They can be optimized in different ways. They can be good at different things. And this is going to be a competitive and evolving marketplace over time. Right? In the software space, we just saw Adobe spend $20 billion to acquire Figma. Why? Because that was an innovative startup that did something new, a new way to do design work. And in crypto, you have other proof of stake chains that were earlier than Ethereum, showing that this works, that it's an efficient mechanism, that it's a more environmentally friendly mechanism. And they were rewarded with market share and market capitalization. Importantly, Rick, this is not the end. This is not the end of crypto's technological journey. Even Ethereum has a major roadmap going forward. The next thing on that roadmap is looking at scaling. How do you go from processing 15 transactions a second to 100,000 transactions a second? And guess what? There are other blockchains out there that are already processing a lot more transactions per second than Ethereum. And Ethereum is in a race to catch up. They have advantages. They have a huge network, a developer community, a massive sort of infrastructure base, but these other blockchains are nipping on their heels. It's part of the reason why I think most crypto assets are best served being diversified in this space. Because do we know that Ethereum will get to scalability fast enough before it's disrupted by Solana or before it's disrupted by a new architecture like Cosmos? It's really hard to know, right? So why not just own the space and let the market sort out how these different competitive frameworks evolve?
Let's take a big picture question as we get close to the end, Matt. And this comes in from two different attendees. And it's on the heels of a statement made by the American Bankers Association last month that you saw. The ABA has strongly opposed the notion of a central bank digital currency. Mm-hmm. When I saw that, I was kind of laughing. That was, it reminded me of the buggy makers complaining about the Model T. So, of course, the American Bankers Association hates a central bank digital currency. Of course, they hate the digital dollar. It's an existential threat to them. Why do we need banking if we have digital money? So talk about that scenario. How do you feel about the notion that crypto could be the next gen of banking and what that could mean for the very basic formation of the American economy?
Yeah, I think it's a sign, it's a strong endorsement that crypto is a substantial threat to the status quo of the traditional financial services industry. And we should all be happy about that. The size of the financial services industry has ballooned over time. The service it provides has not kept pace. Money is still the slowest moving thing in today's society. Fees are way too high. Inclusion is far too low. And what you see in that ABA op-ed is that they're recognizing that there's a threat, which used to be many miles over the horizon. And now you can see it coming and they want to push back against it. So they're going to raise hem and haw and qualifications and concerns to the extent they can to slow down that advancing threat. But in the end, disruptive new technologies win out. There is no reason in a well-designed CBDC that money can't move extremely easily, that base money couldn't be held by individuals, even at accounts at the Federal Reserve. It is an existential threat. There is no real reason beyond some regulatory restrictions why DeFi can't make financial services twice as efficient. And that will mean disrupting many of the largest providers in the space. But it's overdue, Rick. This is the last industry that hasn't been disrupted by the internet. The oldest company in the largest company in financial services was founded in the 1790s. what other industry is there in America where the largest company in a sector was founded in the 1700s? The answer is there's been none, because technology has disrupted industry after industry. And this is finally technology's chance to fundamentally disrupt financial services. And that's what you're seeing in that ABA editorial.
So it just demonstrates how significant this entire movement is and the technological innovation, and why it's so important that advisors be up to speed on this, because it's going to have a dramatic impact on your practice management, on the investment portfolios that you construct and recommend for your clients, and being able to help your clients guide themselves through this with their own careers and lifestyles along the way. And Bitwise is outstanding in its ability to deliver this kind of educational content. And Matt, in fact, Bitwise has just released several new sets of materials. Talk about the new materials you've got, and we're going to put up links in the chat box for this as well.
Sure. Yeah, there are a variety of materials out there. We've actually redone our insights page. So our role at Bitwise is help advisors be up to speed on what's going on in the crypto market. We do a monthly investor letter that people can access. We're working on a series of new white papers, including one on tax loss harvesting that we're very excited about. We have monthly videos where we talk about what are the 3 questions we're getting the most from your peers, from other financial advisors. So would love you to promote those links, and love everyone to go to bitwiseinvestments.com and sign up for that education. It's free.
So take a look at the chat box. We will also send everybody who's watching this and who has registered an email that will contain the links as well. So you'll be able to have quick and easy access. And of course, simply go to bitwiseinvestments.com for a wealth of information. And I strongly encourage you to sign up for Matt's monthly blog and email blast, because it's terrific content keeping you up to date on what's going on in the areas that matter within this subject. Matt Hougan, always a pleasure to have you with us on these webinar series, and we look forward to doing that again with you real soon. I want to let you know about what's coming up next. Most importantly, you need to further your education, but you can do that by obtaining your certificate in blockchain and digital assets. At Bitwise, they put their entire company through this program, and we can encourage you to do the same. The certificate gives you the content you need to get knowledgeable about this subject. First half of the course, all about the tech. The second half, all about practice management, including regulation, taxation, and compliance. And we've added 5 additional courses on generating income through staking, exactly what we were talking about today, understanding NFTs, the many different ways you can invest, and several other courses to come. And I encourage you to read my new #1 Amazon bestseller, The Truth About Crypto, which will give you the content you need to become fluent in this as well. I'm Rick Edelman. Thank you very much for joining us on the program today. A special thanks to Matt Hougan and our friends at Bitwise. And if there's information that we can provide to you, services, a way we can be of value, please reach out to us. That's what we're here for, is to help you get the crypto education you need to build your practice and to better serve your clients. Thanks very much for joining us today. We'll see you next time.